Welcome to Market Brief After Hours. Today was one of those days where the financial charts looked like a double black diamond ski slope. A massive, violent sell-off in technology and semiconductor stocks sent shockwaves through Wall Street, leading to some of the steepest drops we've seen in over a year.
It was an incredibly intense session. The tech-heavy Nasdaq composite led the downward spiral, plunging 4.18%, or about 4%, to close at 25,709. That marks its worst single-day decline since the tariff-related market turmoil back in April of 2025. Over the entire week, the Nasdaq tumbled 4.7%.
And it wasn't just tech feeling the pain. The broader market got dragged down too, right?
Absolutely. The S&P 500 dropped 2.64% to end the day at 7,384. That broke a spectacular streak, marking the index's first negative week in 10. Meanwhile, the Dow Jones Industrial Average fell 695 points, or 1.35%, settling at 50,867. What's wild is that the blue-chip Dow had actually closed at a record high just the day before on Thursday.
Talk about a rapid shift in sentiment. What exactly triggered this sudden rush for the exits, especially in the chip sector?
It seems to be a combination of things. The initial spark occurred earlier in the week when Broadcom failed to raise its AI chip outlook, which disappointed investors who have grown used to blockbusting forecasts. But by Friday, the selling took on a life of its own. Part of it is simple portfolio rebalancing. Many investors have been sitting on massive gains in these semiconductor names over the last few months, and their portfolios became heavily overweight in tech. When the selling started, people rushed to lock in profits.
There's also some fascinating chatter about a massive initial public offering next week playing a role here. Can you tell us about that?
Yes, the upcoming SpaceX IPO, which is set to debut at a staggering valuation of $1.77 trillion. It's being called the largest IPO ever. Some analysts believe tech investors are actively dumping their current chip and momentum holdings to free up cash so they can buy into SpaceX. As one market strategist pointed out, if you want to get into an IPO of that scale, you aren't going to sell your defensive consumer stocks like Procter & Gamble to fund it. You're going to trim your high-flying AI and tech trades. Once that selling pressure started rolling, it quickly turned into a disorderly rout.
And then, of course, we had a major macroeconomic curveball on Friday morning with the U.S. jobs report.
Exactly. The Bureau of Labor Statistics reported that non-farm payrolls surged by 172,000 in May. To put that in perspective, economists polled by Dow Jones were only expecting an increase of 80,000. It was a massive upward surprise. The unemployment rate held steady at 4.3%. Leisure and hospitality led the job creation with 70,000 positions, while healthcare added 35,000. On top of that, previous months were revised higher. April got a 64,000 job boost, and March was revised up to 214,000.
You'd think a strong labor market is good news, but for Wall Street, it usually means bad news for interest rates. How did the bond market react?
It reacted violently. Treasury yields spiked because this hot data essentially threw cold water on any hopes for near-term interest rate cuts from the Federal Reserve. The benchmark 10-year Treasury yield jumped above 4.54%, its highest level since late May. The policy-sensitive 2-year yield climbed to 4.162%, and the 30-year yield advanced past 5%. Higher yields mean higher borrowing costs, which is a direct headwind for capital-intensive sectors like technology and the massive infrastructure build-out required for AI.
With tech getting hammered, did we see money rotating into safer defensive sectors?
We did. Investors quickly pivoted to consumer staples and healthcare. For instance, Colgate-Palmolive gained 4%, Coca-Cola rose more than 3%, and Johnson & Johnson ended the day up 2%.
We're going to take a very quick break. When we return, we'll look at how this tech rout went global, hitting Europe and Asia, and we'll dive into some dramatic technical breakdowns in the foreign exchange and commodities markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we mapped out the dramatic sell-off on Wall Street, but this tech fever quickly spread across the globe. Let's start with Europe. How did their markets hold up?
European markets couldn't escape the gravity of the chip sell-off. The Pan-European Stock 600 index ended the session 0.3% lower. Looking at individual countries, Germany's DAX fell 0.75% to close at 24,759, and France's CAC 40 dropped 0.32% to end at 8,218. Italy's FTSE MIB fell 0.56% to close at 49,893.
On the positive side, the UK's FTSE 100 managed a tiny gain of 0.14%, closing at 10,375, and Switzerland's SMI rose 0.35%.
There was also some fundamental economic data out of Europe that painted a slightly concerning picture, right?
Yes, Eurostat revised the Eurozone's first quarter GDP down to a contraction of 0.2%. This is the first contraction for the bloc since late 2022, largely driven by a massive 12.1% plunge in Ireland's GDP. Meanwhile, Eurozone employment growth slowed to just 0.1% quarter-on-quarter, with job growth completely stalling in France and falling for a third consecutive quarter in Germany. Over in the UK, housing prices unexpectedly dipped by 0.1% in May, missing expectations for a slight rise.
Now, if Europe was a minor tremor, Asia felt like a full-on earthquake, particularly in the tech-heavy regions.
Absolutely. South Korea's Kospi index nosedived by a staggering 5.54% to close at 8,161. Foreign investors aggressively fled the market, forcing regulators to implement program trading curbs. Major giants like Samsung Electronics, SK Square, and SK Hynix all plunged between 6% and 10%. Japan's Nikkei average also tumbled 1.31% to close at 66,588, with semiconductor heavyweights Tokyo Electron plunging 6.6% and Advantest dropping 5%.
What about China and the rest of the Asia-Pacific region?
China's Shanghai Composite fell 0.74% to 4,028, and Hong Kong's Hang Seng Index dropped 1.15% to close at 24,962, dragged down by financial stocks. Australia's S&P/ASX 200 fell 0.70% to 8,625, though New Zealand's benchmark bucked the trend, rising 0.46%. India's Sensex was down a minor 0.16% to close at 74,243, even though they reported stellar GDP growth of 7.8% year-on-year for the March quarter, easily beating expectations.
Let's pivot to the currency markets, because the surge in U.S. Treasury yields triggered some massive technical breakdowns in Forex.
It was a textbook dollar strength story. Let's look at the Euro-USD first. It plummeted 0.72% to close at 1.1527. Technically, this was a major breakdown. The pair closed near its session low, slicing clean through a tightly clustered zone of key moving averages, the 50-day simple moving average at 1.1670, the 100-day at 1.1696, and the 200-day at 1.1680. That structural break opens the door for a much deeper bearish trend.
And the British pound suffered a similar fate against the greenback, didn't it?
Yes, the GBP-USD pair surrendered its key averages in a sharp bearish reversal, falling 0.63% to close at 1.3340. It broke below its 50-day average of 1.3453, its 100-day at 1.3477, and, crucially, its 200-day SMA at 1.3422. It's a significant technical deterioration.
On the flip side, the dollar surged against the Swiss franc and the Canadian dollar.
Exactly. The USD CHF jumped 0.81% to close at 0.7960, forming a bullish engulfing candle that breached its 200-day SMA at 0.7904. And the USD CAD extended its bullish run, closing up 0.24% at 1.3941, remaining comfortably above its 50, 100, and 200-day moving averages. This happened despite Canada reporting a very strong jobs report of its own, adding 87,800 jobs in May and bringing its unemployment rate down to 6.6%. Finally, the Australian dollar collapsed, with the AUD-USD falling 1.23% to close at 0.7045, breaking below its 50 and 100-day moving averages, though it remains above its 200-day SMA of 0.6827.
The strength of the dollar and rising yields also wreaked havoc on precious metals. Gold and silver looked like they completely capitulated.
It was a brutal day for metals. Gold prices plunged 3.53% to close at $4,318 per ounce. This move pushed gold decisively below its 200-day SMA of $4,402, and it's now trading far below its 50-day and 100-day averages. Silver fared even worse, collapsing 7.93% to close at $68.05. It's now rapidly heading toward a collision with its own 200-day moving average at $66.85.
To wrap things up, let's look at some individual corporate market movers and other asset classes that caught your eye today.
We have to mention the individual chip stocks first. The iShares Semiconductor ETF plummeted 10% for its worst day since the pandemic crash of March 2020. Broadcom fell nearly 8% on Friday, following a 12% drop on Thursday. Marvell Technology led the Nasdaq 100 losers, crashing over 16%. Micron Technology, which has been a market darling, dropped 13%, and ARM Holdings lost over 12%.
Outside of tech, there were some big moves on earnings and corporate forecasts, too.
Yes, Lululemon Athletica dropped over 8% after trimming its fiscal 2027 revenue outlook to between $11 and $11.15 billion, which was below Wall Street's expectations. DocuSign also fell over 6% on a softer-than-expected gross margin forecast. On the positive side, Cooper Companies jumped over 8% after beating sales expectations, and the newly spun-off FedEx Freight rose over 6%, capping off a very strong first week of trading on the New York Stock Exchange.
What about oil and cryptocurrency?
Oil prices fell as traders saw signs of de-escalation in the Middle East, despite ceasefire talks remaining in limbo. Brent crude fell 2% to $93.09 a barrel, and West Texas Intermediate dropped 2.83% to $90.41. Meanwhile, Bitcoin had a bruising day, cracking below $60,000 for the first time since late 2024. It fell as low as $59,099 before settling around $60,175, marking a massive 17% loss for the week.
What a dramatic end to the week. A hot jobs report, soaring yields, and a massive global shakeup in the tech sector have completely reshaped the market landscape heading into next week. Thank you for walking us through these complex movements.
My pleasure. It's certainly going to be a fascinating week ahead, especially with that historic SpaceX IPO on the horizon.
That is all for today's episode. If you find this useful, please follow Market Brief After Hours. Have a great weekend, and we'll see you next week.